Look closely at the Indian bond market right now, and you'll see a reversal underway. Billions of dollars in foreign capital are actively leaving the country. This report from the Economic Times details the trend. Foreign portfolio investment inflows into Indian government securities have stalled. The data highlights two factors. Bloomberg is delaying India's inclusion in its global bond gauge, postponing passive funds. Meanwhile, higher U.S. interest rates are pulling capital back. This chart shows the mechanism. As U.S. bond yields rise on one axis, the relative appeal of emerging market debt shifts, moving capital out of Indian securities. When global interest rates rise, foreign capital typically returns to domestic safe havens. This forces the Indian economy to find its growth momentum from within. That internal momentum is currently visible in the retail sector. While foreign institutional investors are looking elsewhere, domestic consumers are spending at high volumes. The strength of this domestic demand is reflected in the latest Q1 results for the Nexus Select Trust, which manages a significant portfolio of Indian retail real estate. Their financial reporting shows shoppers returning to premium malls in record numbers, driving 17% year-over-year consumption growth. For investors, this translates to clear gains. Net operating income increased by 11%, while distributions grew by 10%. This flowchart explains the process. Increased consumer spending allows mall operators to collect higher rents. This revenue is then distributed to REIT investors as dividends. India's domestic consumption engine is currently providing a stable brick-and-mortar buffer against the instability of global capital markets. But while physical malls are thriving, a different kind of infrastructure is facing a severe supply crisis. The global push to build AI data centers requires an immense volume of physical materials, specifically miles of raw copper wire and high-grade silicon. This demand is creating a vacuum. Manufacturers warn that diverting parts to the AI sector leaves standard electronics businesses without essential components. The impact is significant. Standard output could drop by 30 to 40% due to circuit board shortages. These are the printed circuit boards that serve as the foundation for almost every consumer device. Currently, global stock is being diverted elsewhere. Because AI server components command higher margins, suppliers are prioritizing those orders. This funnels the available supply of boards and copper away from standard consumer electronics and into AI server farms. While we often focus on AI as software, its physical requirements are currently disrupting the broader consumer supply chain. Even as hardware makers struggle with shortages, a steady stream of capital is flowing into the software side of the AI ecosystem. This sector rotation is visible in the recent funding rounds. 𝐓𝐈𝐿 is currently raising $75 million in a round backed by global players like NVIDIA. This investment values the company at $1.5 billion. The involvement of major hardware providers in a software round suggests a strategic interest in developing the local AI ecosystem. These localized indigenous models are designed specifically for Indian languages and enterprise needs. By developing these tools in-house, domestic companies can process sensitive data locally rather than relying on foreign-hosted platforms. While hardware remains a global bottleneck, the push for indigenous models like 𝐓𝐈𝐿 suggests India is prioritizing the software infrastructure needed to handle its own data and enterprise needs. These broad market forces, from global supply chains to local startups, eventually reach the individual level, specifically in the field of healthcare. The Indian government is now introducing a safety framework to regulate the rapidly growing dental implant market. These mechanical devices are permanently installed into the jawbone. Because they must function for years within a biological environment, the margin for error is non-existent. This market grew so quickly that it outpaced existing oversight. This resulted in a lack of clinical data tracking and the use of unverified materials, making these new regulations a necessary step for patient safety. Whether the technology is an AI server or a medical implant, rapid growth eventually requires clear standards to ensure the safety and reliability of the final product. We've tracked the shift of capital from international bonds to domestic malls, the physical cost of the AI boom, the rise of sovereign software, and the new rules for consumer health. Thanks for watching Trade Express. Stay informed, stay ahead. Don't forget to like, share, comment, and subscribe for daily updates on business, finance, AI, and global news.